Welcome to the Risk Reversal Podcast. I am Dan Nathan. That is Peter Boockvar. He is the CIO of OnePoint BFG Wealth Partners. What's the story, Morning Glory? How you doing there, Peter?
Great to be back, Dan.
All right, last week we had a little convo. We started the podcast. You were going to head out and see the Oasis at the Giant Stadium. You went there. You rocked the house. They rocked the house, it sounds like. I mean, people won't shut up about this thing. We're going to get to that in a second. We're going to get to some of the real life picks, as you like to call it, in and around some of the stuff that you're doing. It's kind of Peter Lynch-esque, not as much Peter Boockvar. Not yet. So we're going to talk about some of the names that inspired you, and again, you were involved with prior to the Oasis concert. We are going to talk about some of the data that we've seen in front of the all-important August jobs report. There's been some data on the labor market. And then, this Google situation is really interesting to me, the remedy phase of this monopoly case brought by the DOJ or the FTC, one of the two, or maybe both, that sort of thing. But the price reaction or investor reaction to those, I think, is really interesting. Where do you want to start? You had some comments in the book report this morning. That's the BOOCK report. Peter writes every day on that. It's a great subscription, so please go out and listen to that or read that. All right, Pete, where do you want to start here?
Thanks, Dan. All right, well, we'll start with the labor data today, since we get ADP tomorrow on Thursday, and then Friday, of course, the BLS report, whether people believe that those numbers or not. But there's a variety of different statistics with the job opening number today in particular, confirming that the pace of hirings has continued to slow. So the number of job openings, just above 7 million for July, so somewhat dated, fell to the lowest level since September 2024. So that just, again, confirms what we've seen on the hiring side. Pace of firings, though, still remains relatively muted, certainly as measured by the initial jobs claim number. So to me, that is the number of the day today. The hiring rate, which also is a key part of that data, at 3.3% for the fourth or the fifth straight month. And that is just 1/10 off the lowest level since 2013, if we don't include the big drop in COVID. So there's definitely a change in the complexion of the labor market. So that is why the Fed will be cutting interest rates in 2 weeks. Jay Powell told us that in Wyoming, and Chris Waller reminded us again of that on CNBC, not just one cut in his mind, but multiple cuts, as the Fed shifts their focus to the labor market and less so the inflation stats.
All right, let's talk about this for a second, because exactly a year ago, probably to the day, right before the Fed cut 50 basis points at their September meeting, okay, they were more worried at the time about a weakening labor market than they were about inflation. So here we are today. We have all of this weakening labor data. We're going to get to the BLS and we're going to get to all that in a second here, okay? So the Fed remains worried about the labor market, but they're only going to cut 25 basis points. At least that's what the CME FedWatch tool is suggesting. What has changed between a year ago and now, Peter, where they're not going to have what they were called a jumbo cut? And obviously at the time when they cut interest rates, it was 100 basis points over 3 meetings, correct? And there was obviously expectations for that to continue into 2025. But here we are, we're in the last few months of the year, and we've yet to have another cut.
Yeah, that's a great point. A year ago, right on the cusp of the cutting, if you took the Fed funds futures out a full year plus, even through the rest of 2025, markets are pricing in a 285 Fed funds rate. So there was a dramatic amount of cutting that the markets were anticipating. But the Fed got sort of mugged by reality with their 100 basis points of cuts as long-term interest rates went straight up. Now, granted, long-term interest rates were falling going into that first 50 basis point cut, but immediately went straight up as the Fed got deeper into it, because the economy still hung in, the labor market still hung in, the inflation stats still hung around 3%. So the market took a step back and said, hey, all those cuts that we're anticipating from you, well, you'll cut, but it's not going to be anywhere close to what we initially anticipated. So which is interesting today, because the Fed's going to cut from the effective rate of 4.33 to still slightly above 4, but that's well above the 2.85 that the market was pricing in a year ago at this point, at that moment. So to me, this still points to a Fed that is more tweaking policy rather than embarking on this dramatic rate cutting cycle that investors have been so used to over the past couple of decades. Because 3% inflation is still remaining very persistent here. People have to understand, and this is not me talking, this is the dot plot talking. According to the dot plot, and we can throw out the dot plot, we can pay attention, people can do as they wish, but it is what it is. It is an amalgam of their opinion of a real rate that should be at 1%. In other words, the Fed funds rate should be 1% above the inflation rate over a period of time. Well, inflation's still running, core inflation at least, at around 3%, which implies a real rate of, an effective rate of 4%, thus a real rate of 1%. So people that think the Fed's just going to slash and burn interest rates, the only way that's going to happen is if inflation falls down to 2% and stays there, or the labor market really craps out, and that's not why you want the Fed to be cutting interest rates. So it's a very delicate dance from here on why the Fed's cutting, if they're going to cut, to the extent that they're going to cut. It should not be black or white. Oh, rate cut's good, rate hike's bad, buy stocks when they're cutting, and everything's going to be fine.
Yeah, it's different this time, Peter. I just said it. All right, let's talk about the Friday morning BLS. They're going to have, we're going to have August jobs. Okay. And what do you think the market wants to see from the data? And I'm not, forget, let's just say, give or take, the expectation is what, 75,000, and that would kind of be in line from the July number, right? Despite all those revisions from, June and May. But I guess if we were to see a revision higher of the last couple months, if we were to see way better than expected data for August, how do you think investors take that, especially if they feel like there's not a whole heck of a lot of confidence, in how we got to those numbers, if it was such an about phase to the last few months?
I think if you are a bull, the ideal number for you, and I want to think that at least people are still going to have some faith in the number, irrespective of the firing. What they ideally would want, my guess would be, is 50 to 100,000, good enough to keep the unemployment rate from rising, but weak enough relative to the trend over the past year to still have the Fed cut interest rates in September. I think what would be a negative response to the number is if that number was close to zero. And of course, even if it was negative, because then the Fed would be cutting rates for not good reason. Now, if it's hotter than expected, if it's north of 100 to 150, I know how the bond market's going to react. The bond market's going to have a fit, and the 2-year yield's going to go straight up. But the stock market may balance and say, okay, well, a good jobs number, the economy's good, earnings are going to be good, and I'll swallow the rise in interest rates. So that's how I see the different scenarios playing out based on the possibility of numbers. Again, possibly negative, which I do not rule out, or something north of 100 on the flip side.
What do you think the White House response is going to be to a very weak number? Because obviously that helps the Fed, or at least makes the case that the Fed should be cutting more, which is what the White House wants. Or the flip side of that is that we have a really strong number that folks don't think they can trust, but that actually works against the narrative of cutting interest rates.
Well, they'll spin it in multiple ways if it's weaker. They'll say, well, we just put a new head of the BLS in. You got to give him time to make sure the data is correct. That'll be one excuse. The other excuse would be, well, let's blame the Fed. They're keeping the cost of capital too tight, and we need looser money, and this is confirmation of that. They certainly won't acknowledge that a 1%, 1.5% GDP growth rate correlates well with sluggish job growth. They're not going to say that. So, but that's how I see them spinning it if it's weak.
All right. And then let's talk a little bit about yields. You were talking about the direction in which the 2-year might go depending upon what expectations are for Fed rate cuts. Let's talk about this 30-year, because this is something, and it's not just here in the States, but it's global. And it's one of the things that folks have been really kind of worried about as it relates to long duration assets. Is that fair? Guy and I talked about that a little bit. Maybe for the listener, for the viewer, kind of describe why, if you see long-term rates going higher, Guy and I had this conversation yesterday, but I just want to get it from someone smarter than me, why that should put pressure on high valuation stocks like this Mag 7 or just the NASDAQ in general.
Well, certainly the textbook reason would be if the value of a stock is the present value, its future cash flows, and you use a discount rate to figure out that present value, and that discount rate is higher because of higher interest rates, then you get a lower present value. So, that's a theoretical reason why higher interest rates should negatively impact multiples. But also, I think that people should understand that this is happening around the world outside of the Japanese, where the BOJ is raising interest rates and long-term interest rates are rising too. But in other parts of the world, particularly Europe, the rise in long-term interest rates is happening as their central bank is cutting short-term interest rates. So the ECB has cut interest rates by 200 basis points over the past year, and you have French and German 30-year yields at 14-year highs. You had the Bank of England, who's also cutting interest rates, but not nearly to the same extent of the ECB, but still cutting. And their 30-year yield is at the highest since 1998. And we have in the US, of course, the Fed that's about to cut interest rates. And you have the 30-year yield that's continuously knocking on that 5% rate. Now, the relevance of that is, you'd think that if a central bank is cutting short-term interest rates because they're worried about growth, they're comfortable with inflation, you would get a fall across the yield curve in interest rates. But instead, the market is saying, hey, time out here. Maybe that used to be the case, but that was the case under a 40-year bond bull market. We are not in that 40-year bond bull market anymore. We're in a bear market. And we're actually calling you out, government, for excessive debts and deficits. And whether it's in the UK, and I mentioned France, and even Germany that has a debt to GDP ratio of about 65%, we know that that's going higher because of the fiscal spend they're taking on. And the Japanese, well, they have one of the worst financial pictures out there in terms of the size of that JGB market. So investors are pushing back on governments that want to raise money and sell debt at that very long maturity. And the thing to keep an eye on is, okay, I'm talking about the 30, and people can say, well, who cares about the 30 as long as the 10-year yield stays relatively benign and the short end continues to fall. Well, if this 30-year yield around the world continues to go higher, I promise you it's going to take 10-year yields higher as well. And just as we saw over the past year here, the Fed cut interest rates by 100 basis points, and those people looking to buy a home really did not get much relief on the mortgage rate side because 10-year yields are still remaining relatively elevated.
And I think that's a really good point, because you hear the White House talk a lot about trying to loosen up this housing market, and they think that cutting the short-term rates is going to do that. But to your point, we know that mortgage rates are pegged to longer-term interest rates, right? And so if you have that kind of move that we saw last year with the 10-year, it won't do the thing that they hope it's going to do. And that's the thing that I find really frustrating, Peter, is the intellectual dishonesty by these folks. You know what I mean? Like, not by the Fed, you know what I mean? And I know there's a lot of folks who call into question, the Fed and their motives and all that sort of stuff, but it really is happening within the Treasury, and it's happening within, obviously, the White House economic advisors, and their kind of focus on trying to kind of put more and more pressure on this independent agency of the Federal Reserve should make everyone really nervous, because there's people that know better, and they're acting in a way that will not be, I don't think it will be welcomed by investors if we see a whole sale, assault on these independent economic agencies.
Well, the part of the market that's speaking loud and clear to that is the price of gold. I mean, gold is now at an all-time high. And people have to understand that gold yields you nothing. You want a bar of gold, you're not getting any interest income. You have to buy it in the belief that it's going to preserve its purchasing power over something else, particularly the dollar or other fiat currencies. You have to believe that if you plan on buying it to eventually sell, that you're going to sell it to somebody else at a higher price. The reason why this goes up is not just because, hey, I want a shiny metal. There are particular reasons why it goes up. And that's being reflected mostly in this voracious central bank buying, where foreign central banks are saying, hey, we want to own this because we want to own less of other things. And one of those lesser of other things has been the US dollar. And as a percentage of foreign exchange reserves, 25 years ago, the US dollar made up about 72% of foreign exchange central bank reserves. Now it's high 50s. I think it's eventually going below 50. Gold has surpassed the euro in those reserves in terms of its value at about 20%. I think that's potentially going to 30%. It's been as high as 40% plus. So I think people should take the messages that markets are sending. People want to look at the stock market and say, hey, it's at an all-time high, and that's because earnings are good and people have faith in the AI tech trade. They're gleaning messages from that. Well, take messages too from the long end of the world's bond markets, that maybe there's pushback against, like I said, excessive debts and deficits, and maybe inflation that's still rather persistent, and central banks, ex-Japan or even including Japan, are getting complacent now. Take the message from gold. Don't ignore what these markets are saying.
Yeah. Do you find it interesting, the divergence between gold and Bitcoin right here? Because Bitcoin's about 10% off its recent all-time highs. You got to go back, I think, to mid-August when it was trading at those levels. And it just doesn't have a bid. And when you look at gold and you look at like this kind of straight line up that has been, I want to say 3 or 4% just in the last week or so, right? And the dollar hasn't weakened that much. If you look at the US dollar index, it's been banging around this kind of 98 and a quarter sort of level. But you would have thought that maybe Bitcoin, there'd be some animal spirits, if you will, there too. And, it brings me to a comment that Tom Lee of Fundstrat made on our good friend Wilfred Frost podcast, Master Investor podcast. Go follow it in your favorite podcast store. But it was a comment about Bitcoin, and he's all in on this Ethereum treasury company and this strategy. And he's on the board, Bitmine, I think it is, or something like that. And he's gone from, and Wilf asked the question, it was a great question. He's gone from a huge Bitcoin bull to a huge Ethereum bull. He still thinks that Bitcoin will go higher. I think his price target is like $1 million, but he thinks that Ethereum, because of the smart contracts, because of DeFi, because all these other things, and then treasury strategies are just kind of emerging, he thinks that you're going to finally have the flippening. Now, what does that mean? The market cap of Ethereum, or at least the network, is greater than that of Bitcoin. Now, folks have been calling for that since 2017. Right? But I just find that interesting. If the only pillar of the bull case for Bitcoin is a store of value, then it should be acting closer to the way gold has. And you could say, well, it's massively outperformed gold over the last 10 years. That's fine off a very low base. But here we are at 2.5 trillion or something like that. And you would think that it would be joining the party with gold.
I think in Bitcoin's 16 years of life, what it is still not achieved is a high correlation to the price of gold. And yes, it's done phenomenally well. And those that have owned it have done great with it. And I'm not going to talk that down. But if it wants to be a store of value, as you said, if it wants to be similar to gold and digital gold, as we've heard a million times, well, then it should trade like gold. It should not trade like the NASDAQ 100. But it continues to trade like the NASDAQ 100. The other interesting thing that I find with Bitcoin is over the past couple of months, seemingly every day, there was some new company creating the Bitcoin treasury. And whether it was a SPAC or a shell company turning into a Bitcoin treasury, or a hotel company that's adding Bitcoin to their balance sheet, or a biotech company, and all this Bitcoin buying from all these different entities, and I think there was a couple hundred of them, and Bitcoin still can't get out of its own way, tells me that, again, it's still trading more like a speculative tech asset rather than gold. Now, at some point, maybe it matures and it trades like gold, and maybe it actually becomes a sort of a complement to gold, but it hasn't proven that yet.
And again, I just find it interesting, to your point, that it feels like more like a Mag 7 stock at its market cap, and the way it trades, the correlation to the NASDAQ is definitely fairly interesting. I'm going to hit one story from the Wall Street Journal that I thought, you might have something to say on. It came out last night. Behind the scenes bumper earnings, job cuts, price hikes, and glum workers. So American companies are exceeding profit expectations largely by cutting costs, boosting productivity, and adopting new technologies. Companies are holding down hiring, finding ways for employees to work more efficiently, and raising prices where possible. So all of those sorts of, components to like this profit surge that we're seeing in the S&P 500, they seem to be the sort of thing that could weaken consumer confidence, which is already not great. It could also start to weaken margins for companies that are enjoying these profits right now because they're at peak margins, right? And if you start to see weaker consumer confidence, if you start seeing less ability to pass through some of these costs as it relates to the trade war and the like, this seems to me like this could be the reason why we start to see a much more pessimistic view by companies about the trade war, despite all the pull forward and all the benefits that they've seemingly had also from the tax cuts.
Well, we do know, and your friends at FactSet do a great job of this, that most of the earnings gains in Q2 were big cap tech. And if you X that out, the rest of corporate America is struggling to drive earnings growth. Tariffs, I've always said, is just mud in the gears of business. And if you listen to a lot of calls from companies that are dealing with tariffs, they're taking the mitigation is the word. What are they doing to mitigate the impact of tariffs? And one of the ways of them mitigating it is keeping down costs. And what is the biggest cost for a lot of companies? It's labor. And that is a factor on that side. On the consumer confidence side, wage growth has been pretty good over the past 5 years. The problem is that inflation has gone straight up too. So if you were keeping up with inflation but not exceeding it, then you've just spent a bunch of years running in place. And that wears on you. And you see the price of stuff still being very elevated because the average consumer is not thinking about rate of change. They're thinking about the absolute level of prices, and they just can't get ahead. So I think that's why when you look at the Michigan confidence number, the Conference Board consumer confidence number, these numbers are still well below where they were in February 2020, right before COVID hit.
It'll be really interesting. I think this is a back half story that's going to bleed into 2026 estimates.
I'll add to that right now, Dan. I just listened to the Petco earnings call, a stock we own, unfortunately, because it's been a complete dog, no pun intended.
Yeah.
But they said the impact of tariffs. Now they import a lot of supplies. You have your consumables, like your food that you're selling every day to buyers, to consumers, and then you have more supplies that are more discretionary. And a lot of those supplies they're importing from overseas. They said in the quarter that just reported, there was a very negligible impact from tariffs. However, that's going to go up meaningfully in Q3 and much more meaningfully in Q4, because what companies have done up to this point is they've sold the inventory that they procured pre-tariff. From now through the rest of the year, the goods that they're selling or the tariffed stuff that they've imported. So margins in the back half of this year, if Petco is any example for broader corporate America, profit margins are going to get squeezed for those that are negatively impacted by these tariffs in the back half of the year if they can't fully mitigate it. And even if they can mitigate it, somebody's eating that mitigation, and most of it are either consumers, employees, and much less so the exporters to us.
It's so funny. There's so few strategists. We have so many come on Fast Money and some of the pods who are really kind of speaking that sort of language. It seems kind of obvious, right? If a big benefit was the kind of the pull forward and your ability to kind of sell goods where there was demand for those goods, whether it was Apple or, some other kind of, discretionary sort of items, like there's got to be another side of that, right? Especially when we don't see, these tariff rates adjusted too much lower. All right. You went to MetLife, 2 consecutive shows out there. Oasis, we know that they've been kind of in every major U.S. city, sold out, 85,000 seats, that sort of thing. If you went and looked, if you didn't get them, even actually first run from Ticketmaster direct, the pricing was out of this world. So since the pandemic, you've seen a lot of these bands that didn't get to travel for 2 years. It's the only way that they really make money. Now, Oasis is very different because they haven't toured in, 15 years or 20 years or something like that. They were charging like premium seats were over $1,000. Normal seats were like $500. If you wanted to be all the way up in an end zone in the third tier, maybe they were $150. So, this has turned into an all-out free-for-all in the concert space. But at some point, if you have a weakening consumer, this is something, even experiences, even something that was so much pent-up demand for, might you see a pullback? And I know you're going to go to Live Nation because this is a stock that was trading, $95, I want to say, a year ago. Today, it traded at a new all-time high. It opened around $166. Now it's 161.5. Great run here. Give me the 411 about how you're thinking about the space. Let's start with the concert, the space, and then the stock in particular.
All right, I'll start with the concert. I paid face value, and this is without fees because my son started working in the music business, so I can bypass Ticketmaster.
Nice.
But it was still $400
Yeah.
per ticket. So
Yeah.
I spent $800 for 2 tickets, face value, not even on the floor, not even front row, good seats on the side in the 100 sections, but that's pretty pricey. And before I even get to Live Nation, I'm going to mention a company that reported earnings last week, Affirm, buy now, pay later, because more and more people are using buy now, pay later just to pay for their concert tickets. Yes, they're paying for groceries with it, but they're also paying for their concert tickets with it. Because if you can spread out your payments, hey, why not? Especially a $400 ticket. Now, as you mentioned, Live Nation, we've been long it since the high 60s when the Department of Justice initiated their case against them. But yeah, it's had a nice run here because of the ability to charge those prices. And these shows are still selling out. Benson Boone is playing Madison Square Garden Friday night. And for an average ticket, he's charging like $250.
Wow. And I've never even heard of him, by the way, Benson Boone. Who is that?
Benson Boone is a big up-and-comer that is getting really popular. And and has the ability to charge over $200 for a random ticket in Madison Square Garden.
You know what's amazing? When we were younger, Peter, I mean, playing Madison Square Garden for a rock band was like, that was it. That was like, you've reached the kind of mecca, right? And now I've never heard of Benson Boone. And they're playing he, them, whatever. They're playing at Madison Square Garden. It just seems very odd to me. Yeah, the ticket thing, I go to a lot of concerts. As you know, I know you go to a lot of concerts. I'm just resigned to the fact that if it's a band that I really like, that I'm going to be paying up for a great seat, that sort of thing. And I only really want to go to concerts if I have great seats. So it seems like it's a great time to be a ticket issuer. That being said, I don't know if you saw this, StubHub's trying to go public, and they missed some of their estimates prior to even going public. You'd think that, obviously you're trying to make things look as good as possible, to tell a better story. And then you better make sure that you hit those numbers on the first report away from your IPO. But that doesn't seem to be a great spot. Now, StubHub is a secondary ticket company. Like, for instance, that $400 face value ticket that would have been $450 with fees on StubHub would probably be $900 and then maybe $1,100 with fees, So that might be the first sort of, kind of giving you a sense of where the stress in the market is, and maybe it works its way down to the primary ticket sellers.
It's possible, but one of the reasons for StubHub's issues, and a lot of ticket brokers are experiencing the same thing, is Ticketmaster and some of the primary sellers are trying to close that gap between what the secondary market prices are going for and what those primary initial sales are going for. Because the last thing an artist wants to see is selling an average ticket of, call it $200, and seeing it 2 minutes later going for $600. Then like, well, I left a lot of money on the table. Now, granted, it's a balance. They want to make their fans happy and make their ticket affordable, but also they don't want to leave too much on the table to these scalpers. So what Ticketmaster actually, speaking of Oasis, what they did with Oasis is they held back a bunch of tickets that they released literally the day of and the day before to try to give the fans the ability to buy them at face value and lessen the opportunity for that secondary market to profit from the lower primary prices.
Yeah, and all that's good for Ticketmaster. They've done a really nice job, I think, with a bunch. I know they had a lot of negative press. The first Springsteen's tour right out of the pandemic, and then Taylor Swift, that sort of thing. But like, for instance, I bought a bunch of tickets in fan pre-sales where the only way you can actually sell that ticket is going through a verified fan thing, and it's going back at face value. Pearl Jam does that too. All right, before we get out of here, Peter, let's talk about this Google situation, because the stock, we are about an hour and a half into the close on Wednesday. The stock is trading at an all-time high, up 8.25% or so. Maybe it was up at 9%. That is an astounding move based on news that I thought was really good for the company, but I didn't think, and we were talking about it on Fast Money last night as kind of a lot of this news was breaking and people were trying to figure it out. It's like the stock was at an all-time high, and the stock is the only in the Mag 7 that actually was trading within 1% of its all-time high. Most of them are down more than 5% or so, even with the NASDAQ at all-time highs. So I didn't think there was a lot priced in for this. if you are buying this stock right here, up 8% at an all-time high, it just makes no sense to me. So what do you make of this? They get this ruling. It's not nearly as bad as that some feared, but I don't think many people were pricing in the worst case scenario they're going to sell Android or be forced to sell Chrome.
Yeah, I mean, the last point nails it. I don't think people were really expecting. I mean, when you think about the history of government attempts to sort of break companies up or to force a major spin out of a hugely profitable division. I mean, maybe AT&T was the last success that they had. So I don't know why people were thinking that somehow the government was going to win this time. So it's definitely a positive, but we can also look at it as it's just a lack of a negative. And I don't think the stock price really reflected worries about it. Now, granted, it's got a lower multiple than some of the other Mag 7s, but that's a different conversation. So it is a surprise. But the interesting thing is that investors who are buying the stock today, what the judge also did and said was, hey, I'm going to leave this alone because look how competitive your space has gotten. And investors should understand he's right. This is an extraordinarily competitive space now, search and Gen AI and so forth. And Google may win. Maybe they do. But they should take heed that this is the most competitive, most fiercely fought battle right now in technology. And I know something that we talked about last pod is it's not just competition within the US, it's competition globally. But investors should keep that in mind too, those that are chasing it today.
Yeah, 90% of search queries are basically go through a Google platform. Okay, 70% of the search advertising revenue goes to Google. And your point about, this market share, it's never going to get any better. They're going to have to actually cannibalize themselves to some degree. So consumers that are getting stuck on, OpenAI or Perplexity, right, are willing to kind of stick with Google and see these AI overlays and really kind of work with the company as they realign that whole search experience. But more importantly for Google, it's not just consumers, is that they have to get advertisers comfortable with this, right? So if it used to be that, you would pay Google when you would have somebody click on the blue link, you know what I mean? If no one's clicking on blue links anymore because they're getting these contextual answers and the AI overlays, well, then you got yourself a little bit of a problem. So as far as I'm concerned, as far as the next year or two, if you were thinking about why this company was trading at a discount from a multiple perspective to, let's say, a Meta or a Microsoft, well, there was good reason to do that, right? And if you think about, because it's their monopoly, going back to the initial ruling. So I think this is going to be a really interesting space. I'm shocked that the stock is up 8%. I'm just going to tell you that right now. I'm also very surprised that Apple's up 3%. We know that they have an exclusive deal to have Google search on iOS devices, and it's $20 billion a year, that sort of thing. I just don't think there was a lot being priced into Apple either, Peter, for this whole situation. So,
yeah, I don't think people were adjusting or giving the caveat of earnings estimates minus the $20 billion that Google pays Apple. And what would have been interesting is, let's just say the judge ruled differently and said, Google, you can't pay that, no more paying that $20 billion to Apple because that gives you sort of monopoly status. Well, theoretically, that would have been a huge boost to Google's earnings, a big hit to Apple. Should we have rallied Google if they lost that access?
No.
Well,
yeah.
I guess yes, because they just added $20 billion to their profit line.
Yeah, except for the fact that it just makes the challenges about the new search landscape that much more difficult, right? When you think about
they have a less dominant presence.
Yeah,
sure.
like 1.5 billion iOS devices. So, yep, I got that. All right, Peter, we covered a lot of ground here. I really appreciate you being here. Guys, check out the book report, BOOCK report. It's one of my first reads. Peter updates everything that's going on, definitely on the macro, but he's hitting a lot of, that Petco example you gave. There's very few folks out there drawing these sorts of conclusions about this stuff and trying to figure out, extrapolating. That's the sort of great work Peter does here. So we appreciate you being on the pod. Check out his book report. Thanks, Pete.
Thanks, Dan.